Is the European market about to head off on a flyer? Well, it may do if the European Central Bank reacts to that slow economy and starts doing quantitative easing, that is pumping more liquidity into the economy. Of course, that would have a huge impact on the markets in the same way that quantitative easing in the US helped push the S&P 500 there up about 200% in 5 years. Well, to find out what this may mean, I'm joined by David Rogers and Adam Carr. David, first of all, why is the ECB even contemplating doing this again?
Well, Jackson, European economic growth continues to slow. It's very dormant, could we say. And inflation is near zero. It slipped below zero in the latest month for the year-on-year basis. Even allowing for low energy costs, it's very low. So there's a danger that people will start deferring their spending for consumption. That's the European Central Bank officials don't think that we're really there yet, but dangerously close. So Draghi, the ECB chief, has already said 18 months ago that he'll do whatever it takes to preserve the euro, and it's coming up to one of those times, and the European ECB officials, led by Draghi, have said that they're going to do major stimulus this month. So it's just a question of exactly what they do.
Now, Adam, that concern, of course, is deflation. Just for people who don't know how bad that might mean, I mean, how bad is deflation for an economy? Because if prices are going down, that's surely a good thing, right?
Yeah, well, it's not always a bad thing. I think the concern this time around, as David mentioned, was that people start deferring consumption. And there's also a view that deflation is bad for debt holders. And obviously there's a lot of debt out there, isn't there? So it's and in Europe and everywhere else. So deflation effectively lifts the value of that debt. If you've got prices falling, wages falling, then in real terms your debt level goes up.
Okay, so how much money is the ECB talking about in terms of pumping into the economy?
This is the thing. Late last week we had a Bloomberg report, saying the figures presented to the European Council meeting were for only a 500 billion euro. Sounds like a lot of money, but Draghi has hinted at doing up to €1 trillion of QE, bringing the balance sheet, the ECB's debt, back to the previous high. So, of course, it's no guarantee that it will be 500. It could well be more. I think, is more likely to be surprising the market on the upside. But there are a lot of obstacles, particularly from the German side. I mean, German officials don't seem to be there yet in terms of embracing QE.
And why are the Germans so concerned about this?
Well, look, their argument is that deflation isn't a threat, and I think that they're concerned that any quantitative easing program would just discourage the peripheral economies, or let's get away from that, or some economies within the European, the euro area, from public
sticking to the austerity and so
on.
Yeah,
exactly, sort of spending restraint, which is what they want, because we've got to remember that the fundamental issue for some economies in Europe was debt, Greece in particular. And the Germans are saying, well, how is buying their debt up going to help them from the fundamental reforms they need to undertake, which is stop spending so much, stop being so corrupt, if you can say that. So that's what their attitude is, and it's a fair attitude, I think.
Of course, the legality of this is not even certain. Whether under the Maastricht Treaty they can buy, sovereign debt.
Yeah.
And there's a ruling on that tomorrow night, right, from the European Court of Justice.
Yeah. Look, there have been challenges throughout. The German Constitutional Court has been called upon to sort of rule on the legalities of various programs. So I'm not sure how, whether that'll move the market for too long a period. You might just get some market jitters if they come up with an unfavourable move.
It's an opinion rather than a ruling, which should be clear.
Yes.
But given that it is now being debated at the highest levels and it might get through despite some German opposition, I mean, if there is a new wave of liquidity pumped into Europe, I mean, what would that mean for European markets?
Well, I think if they deliver the full, more particularly if they deliver open-ended quantitative easing, which is what the Fed eventually moved to, that is, they will say that we're going to print X amount of euros and buy X amount of bonds indefinitely until the economy picks up. That'd be a major breakthrough. And the euro has fallen 15% in the last 6 months or so. I think that'd start another wave down in the euro against the US dollar, potentially down to record lows around 80 euro cents, and the stock market would probably get a significant boost. I wouldn't bet against the ECB at this point. They hold all the cards.
They need to really sort of gazump or trump the market, wouldn't they? Just say, take that, you know, and for the market, I think, to get a decent rally equity market I'm talking about here.
That's the other thing, is that we do have that Greek election a couple of days later, so maybe it'll be a buy rumour, sell fact.
We'll see. Well, maybe would they want to move prior to the Greek election? Maybe they don't want to sort of interfere too much or be seen to interfering. Sorry.
Yeah, sure. But I mean, if you're looking at an open-ended quantitative easing program, I mean, if you look at what happened in the US, right? So the S&P 500 goes up by, double effectively, and a lot of that is because of cheap money being pumped into the system. So if you're an Australian investor, should you say, well, why bet against central banks? I might as well get involved in the European stocks.
Yeah, you shouldn't. I don't think you should. I guess the issue is the duration of any rally, assuming they don't disappoint the market. I think there is scope for them to disappoint the market if they're viewed as being too conservative. And the issue, I guess the benefit that the US had was that they had an accelerating economy, which Europe doesn't. So that was an advantage, and so
and it's one country, of course.
Versus 12. So, but when you see an economy which is accelerating sharply, and then the central bank's still printing money, of course the equities are going to go up. But for Europe, it's a little bit different. I still think we will get a rally provided they don't disappoint the market. But how long that lasts is a big question mark.
Whether the labour
because
market
the economy
and the key reforms haven't gone through in Europe in the way they did do in the US.
They're not addressed.
Which is a big difference.
Exactly.
But David, so you think it's not a case of jump on the back of the Fed's coattails and ride it for 6 months or so. You say that it's much more sensible to really be quite careful about how you make this investment.
Well, I think for the next 2 weeks, I wouldn't be shorting equities globally outside of circumstances where they're affected by lower oil prices and so on. But I think for particularly markets that can benefit from low interest rates, Australian banks even, they could have lower funding costs if the euro prints more money. And it will tend to enhance that search for yield around the world. Australia does have some decent yielding stocks.
And of course, those European investors have now got access to cheap money where they might want to put that into Australia, because that worked with US investors coming to Australia, right?
Yeah, absolutely. I mean, it's not going to be good for the Aussie dollar for those who want a cheaper or lower Aussie dollar, who want to send us back to sort of third world status. And obviously, Aussie dollar could get a bit of a boost.
All right, gentlemen, thanks very much.
Thanks, Jackson.